All right, let's just dive right into one of the biggest, most debated questions in the entire market right now, Nvidia. Its growth has been absolutely off the charts, and that has everyone screaming the word bubble. But what if that's not the whole story? What if it's actually the opposite? Let's break it down. First, to get a sense of the sheer scale we're talking about, just look at this number. This was Nvidia's market cap heading towards $5 trillion in early 2024. Yeah, trillion with a T. I mean, that's a valuation so huge, it's bigger than the entire economy of most countries on Earth. It's just staggering. And right there, that's the paradox. You see a number that big, and your brain immediately thinks, no way, that has to be a bubble. But the question that serious analysts were asking, the question their models were pointing to was, what if it's still a bargain? I know, it sounds absolutely wild, but that's exactly what we're going to get into. So let's frame this whole thing. On one side of the scale, you have these totally legitimate, widespread fears of a massive market bubble. But on the other side, you've got this incredibly strong fundamental data that suggests the company is actually growing into that massive valuation. See, to really get the paradox, you have to get this. Nvidia isn't just some company in the AI boom. It is the engine. It's the company building the picks and shovels in a gold rush. We're talking about a 90 to 92% market share in the essential chips that make AI possible. That's not just a lead, that's borderline a monopoly. Of course, anytime you see this kind of insane growth, you get flashbacks to the dot-com bust. And this quote from a deep dive research paper by Dean and Francis faces that head on. They're basically saying, yeah, you absolutely have to be careful, but then they make this key distinction. Even at this price, Nvidia's valuation is built on something much more solid than a company like Cisco's was back in 2001. So that leads to the big question, right? How do you actually figure out what a company this dominant, this unique, is truly worth? Let's take a look at how the pros actually do it. So, you've basically got two main schools of thought. Relative valuation is pretty simple. It's like pricing your house by checking what the other houses on your street sold for. The problem is, with Nvidia, there are no other houses on the street. It has no true peers. And that's why analysts lean on intrinsic valuation. This method doesn't care about the neighbors. It's a deep look at the house itself, valuing the company based on its own power to generate actual cash, now and in the future. Okay, so we're using the intrinsic method. Now, let's pop the hood and look at the engine the researchers used to get a real number. It's a model called discounted cash flow, or DCF for short. Now, don't let the fancy name scare you. The idea behind a DCF model is actually pretty straightforward. It's just a way of asking, what are all the profits this company is going to make in the future worth to me right now, in today's money? You're basically taking a stream of future income and calculating its lump sum value today. And it really just boils down to three main steps. First, you have to make an educated guess about all the cash the company is going to generate over the next few years. Second, you calculate a discount rate, which is just a fancy way of accounting for risk, because a dollar tomorrow isn't guaranteed. And then third, you use that rate to shrink all that future money down to a single value for today. So, the moment of truth. After all of that number crunching, after all the assumptions about growth and risk, what did the model spit out? Well, using the financial data from January 31st, 2024, the analysis landed on an intrinsic value of $974.70 per share. And here's where it gets really interesting. On the day this analysis was run, Nvidia's stock was actually trading at about $615. So this super detailed financial model didn't just say Nvidia wasn't in a bubble. It said the stock was a bargain, potentially undervalued by almost 37%. Okay, but that's just one model from one team of researchers, right? It's a snapshot in time. What was the rest of Wall Street thinking back then? Let's zoom out a little bit. What I love is that the same researchers ran multiple scenarios. And look at this, even in their bear case, the what if things go kind of wrong scenario, the model still came up with a price of almost $790 a share. That was still a huge jump from where the stock was trading. And hey, talk is cheap. What about the people betting their own money? This shows us what the options market was saying in early 2024, and it's not even close. Almost 81% of the money was betting that the stock was going to go up. That's an incredibly powerful sign of where the real conviction was. And that conviction wasn't just from options traders. This number, $253, was the average upside that 58 professional analysts were predicting at the time. So they were basically saying that on top of its $615 price tag, there was still another 253 bucks of growth to go. That consensus view was overwhelmingly bullish. And this quote from Dr. James Fox just nails the reason why. This isn't like the dot-com bubble where companies were built on hype and a prayer. AI is a real tool that's creating real productivity gains today. The demand for these chips isn't speculation. It's based on actual, tangible utility. So the fundamental case for Nvidia being a bargain, even at these prices, seems pretty strong. But let's be realistic. No investment is a sure thing. We have to look at both sides of the coin, the things that could propel it even higher, and the storm clouds on the horizon. First, the good news. And boy, is it good. We're talking about a reported $500 billion backlog of orders. That's insane visibility into future revenue. Their profit margins are well over 70%, which is just incredible. They keep rolling out next-gen chips that keep them years ahead of everyone else. And maybe most importantly, their CUDA software platform creates this huge moat, making it super painful and expensive for customers to even think about switching. But you have to look at the risks, and they are real. Competition from heavyweights like AMD and Intel is definitely heating up. The entire chip supply chain is complex and can be fragile. And look, when your valuation is this high, you have zero room for error. Any stumble, any miss on earnings could get punished hard. And on top of all that, you have the constant wild card of geopolitics and trade wars. So that's where we land. The deep dive analysis suggested there was real value. The market, at least at the time, was incredibly bullish. The story seemed solid. But with a company this big, moving this fast, in a world that's changing exponentially, you have to wonder, what's the one thing nobody is thinking about? What's the unknown variable that could rewrite this entire script? That's the billion or maybe trillion-dollar question.